Right now, as you are watching this video, a clock is running. Trump just issued a 48-hour ultimatum to Iran: reach a deal before Monday, or the military campaign escalates into something that makes the last 5 weeks look like the opening act. And buried inside a Wall Street Journal report from Thursday night is the number that should be screaming across every financial broadcast in America. 10,000, that is how many additional combat troops the Pentagon is preparing to deploy to the Middle East. Not logistics workers. Not support staff. Frontline combat units. This comes on top of the 5,000 Marines and thousands of 82nd Airborne paratroopers already ordered into the region. If the president approves, total American ground forces in and around Iran cross 50,000, the largest combat deployment since the Iraq War. And the decision comes next week. Read that one more time. Next week. The same week the Dow just closed Friday down nearly 800 points. The same week Brent crude hit $112.42 a barrel, up $34 from exactly 1 year ago. The same week 30-year mortgage rates climbed to 6.46%, the highest level in 7 months, up from just under 6% on the day this war began. The same week Moody's recession probability model, the one with 80 years of back-tested accuracy, printed at 49%, one tick from the threshold that has never been crossed without a recession following within 12 months. The same week the OECD revised the United States inflation forecast from 2.8% to 4.2% for 2026. If you own a home, drive a car, buy groceries, or have a single dollar in a retirement account, what comes next in this video is not optional. To understand why these numbers are going to deteriorate further before they stabilize, you have to understand what is actually happening on the ground. So let us start there. On February 28th, the United States launched a coordinated campaign targeting Iran's military infrastructure, defense networks, and nuclear program at Isfahan, Fordow, and Natanz. In the first 3 weeks, the campaign achieved significant results by any conventional measure. Those nuclear facilities are believed to have been set back by years. Iran's conventional military capability was substantially degraded. On paper, the early results look decisive. But air power has one absolute limitation. It cannot physically control a waterway. The moment the conflict began on February 28th, Iran moved to seal the Strait of Hormuz. Under normal conditions, that 21-mile-wide choke point moves roughly 20% of the world's entire daily oil supply. Since the closure, traffic through the strait has crashed by 95%. Nearly 100 ships, almost exclusively Chinese and Indian tankers, have been allowed through. Allied commercial shipping has been blocked entirely. Iran is charging tolls of up to $2 million per passage for vessels it does permit. Iran has maintained anti-shipping operations out of fortified positions on Qeshm Island, the largest island in the Persian Gulf, sitting directly beside the strait. Those positions have proven resistant to the campaign. Disruptions to Gulf oil infrastructure and regional facilities have continued throughout. The IEA called this the greatest global energy and food security challenge in history. Gulf oil production from Kuwait, Iraq, Saudi Arabia, and the UAE is down at least 10 million barrels per day since mid-March. Qatar declared force majeure on all liquefied natural gas exports. Dubai International Airport and Abu Dhabi sustained operational disruptions. More than 4,000 flights are being cancelled daily across the Gulf region. South Korea held an emergency parliamentary session this week and passed a $17.3 billion supplementary budget just to shore up its economy. President Lee Jae-myung called this the worst energy security threat his country has ever faced. In Europe, Shell issued a warning this week that the continent could face a fuel shortage as early as April. The European Central Bank postponed its planned rate cuts on March 19th and raised its inflation forecast, warning that Germany and Italy risk technical recession by year-end if this blockade holds through summer. Here is what almost nobody is saying clearly. This is not an oil story. Oil is just the part that shows up on your gas station price board. The Strait of Hormuz region accounts for roughly 45% of global sulfur supply. Sulfur is the foundation of fertilizer production, metal processing, and industrial chemicals. Gulf countries supply enormous shares of global urea and ammonia. With those export routes shut, fertilizer prices are projected to roughly double from 2024 levels. Phosphate could climb 50%. And this disruption is landing in the middle of the Northern Hemisphere's spring planting season, right now, as farmers need these inputs most. The UN World Food Programme has already confirmed these disruptions are building long-term food price increases. The region also supplies a significant portion of global helium, a gas without which semiconductor fabrication cannot function. Oil, food, electronics, all flowing through one waterway, sealed for 5 weeks, with no clear end date. This is why the 10,000 troop number changes everything. The Pentagon has concluded that air power alone cannot break the blockade or force a resolution. The options being developed are built around what officials are calling a decisive blow: ground operations to seize Iranian strategic assets of sufficient value to force Tehran to the table. The primary target is Karg Island, roughly 15 miles off Iran's coast. President Trump has publicly called it Iran's crown jewel. Approximately 90% of Iran's total crude oil exports pass through Karg Island before tankers approach the strait. Capturing it would hand the United States direct control over the revenue engine of the Iranian regime. A second target under consideration is Keshem Island itself, where those hardened tunnel networks have survived everything the air campaign could deliver. A third scenario involves securing Iran's strategic nuclear material, currently believed to be dispersed across the damaged facilities. Retired Lieutenant Colonel Daniel Davis, senior fellow at Defense Priorities, was blunt: the current 82nd Airborne Contingent represents roughly 4,000 to 5,000 combat troops, enough to take a limited objective briefly. The 82nd is a first-wave force. It is designed to hold a position while a heavier main effort arrives behind it. The 10,000 additional troops are that main effort, heavier units built to hold contested territory for weeks. If Trump signs this deployment order, it is not a plan on a whiteboard. It is active preparation for a ground operation. Now let us talk about what all of this is doing to your money. Markets are not waiting for the announcement. They price the probability all week, and what the price action is telling us is something financial television is actively refusing to name. Thursday's session, S&P 500 down 1.7%, its worst single day since February 28, Dow down 469 points. Nasdaq down 2.4%, officially in correction territory, more than 10% below its all-time high. Russell 2000 down 10.3% from its January peak. The VIX surged 11% in a single Friday session. The S&P 500 is heading for its 5th consecutive losing week. The last time that happened was 2022. Stocks overall are down nearly 5% since the conflict began, capping the worst quarter in almost 4 years. This is not a pullback. A pullback is noise around a trend. What we are watching is a market systematically repricing lower earnings, higher costs, higher rates, and a prolonged conflict. There is one episode from this week that reveals how distorted this market has become. A Financial Times investigation noted unusual activity in oil options markets in the minutes before President Trump's March 23 statement about pausing diplomatic pressure on Iran. When oil dropped on the news, those positions generated significant profits. When the pause proved temporary, oil resumed climbing. The episode is a direct reminder of how fast this market moves on diplomatic signals and how important it is to understand the information environment you are operating in as a retail investor. Meanwhile, gold has fallen nearly 17% this month. That puts it on pace for its worst monthly performance since October 2008. That sounds like a contradiction during an active geopolitical crisis. It is not, once you understand the mechanics. Higher oil prices shift central bank policy expectations globally. If energy inflation forces rates to stay elevated longer, the opportunity cost of holding gold, which earns no yield, rises relative to rate-bearing assets. Investors sell gold to rotate into instruments that benefit from the rate environment. This is the same pattern that played out in 1973. Gold fell first, then surged months later as the full inflationary wave transmitted through the global economy. Bond prices are falling simultaneously, pushing long-term Treasury yields higher as markets price in persistent inflation. And with the Trump administration needing $200 billion in additional appropriations, the supply of new government debt hitting the market adds further upward pressure on yields. When stocks, bonds, and gold all sell off at the same time, that is not a sector rotation. That is a liquidity squeeze, institutions raising cash at whatever price is available. It is the same fingerprint that appeared when Metropolitan Capital Bank failed in January, and the same pattern appearing now, across every major asset class simultaneously. Let us put hard numbers on your household. Brent crude settled at $112.19 Thursday. WTI closed at $98.32. On February 28, when the war started, Brent was around $81. A 38% move in under 35 days. At the pump, the national average hit $3.50 per gallon by mid-March. In Los Angeles, $8.29 per gallon at some stations as of March 25. Pakistan imposed a 4-day government work week to conserve fuel. Bangladesh has queues at filling stations. Analysts at Barcart reported this week that price targets of $200 per barrel are now circulating among institutional forecasters. Here is the damage that has not been making headlines. Mortgage rates. 5 weeks ago, on the last day of February, the 30-year fixed mortgage rate was just under 6%, the lowest in more than 3.5 years. The spring buying season was about to begin. The housing market was finally showing signs of recovery after years of frozen inventory. Then the conflict started. This week, Freddie Mac confirmed the 30-year rate climbed to 6.46%, the highest level in 7 months, rising for the 4th consecutive week. On a $400,000 home with 20% down, that rate increase costs a buyer an additional $83 per month. Over a 30-year loan, that is nearly $30,000. Joel Berner, senior economist at Realtor.com, said publicly, the situation in Iran has seriously complicated the spring buying season. The 10-year Treasury yield hit 4.44% on Monday, and mortgage rates track that yield directly. Every basis point higher in that yield translates into tighter conditions for anyone trying to buy, refinance, or finance a business. The OECD revised its 2026 U.S. inflation forecast from 2.8% to 4.2% this week. The Federal Reserve's own March projection was 2.7%. That means the OECD is projecting inflation more than 50% higher than what the Fed estimated days before. CNBC economists estimate that sustained oil at $100 per barrel through year-end could push CPI to 3.5%. Above $110, which is where we are sitting right now, the number climbs higher still. The February CPI print was 2.4%. We are looking at the possibility of inflation nearly doubling within months, driven almost entirely by one sealed waterway. The Federal Reserve is locked at 3.5 to 3.75%. At its March 18th meeting, it acknowledged the Iran conflict has created uncertainty it had no framework for. Rate cut expectations have not dimmed. They have collapsed. Traders who came into 2026 pricing in multiple cuts are now pricing in zero, with some models showing a non-trivial probability of a rate hike. An interest rate increase during an active international conflict, with markets falling, mortgages rising, and $200 billion in emergency appropriations being requested, has no precedent in modern American monetary history. But if inflation hits 4% and keeps moving higher, the Fed's statutory mandate may leave it no choice. Mark Zandi of Moody's Analytics said it plainly, "I think recession's a real risk." Ed Yardeni took his market meltdown and recession probability from 5% to 20% in a single week. David Kelly at JP Morgan Asset Management called this combination a very nasty 1-2 punch. This is stagflation. Rising prices. Slowing growth. Falling employment. The United States economy added just 116,000 total jobs in all of 2025, the lowest outside of a recession since 2002, and actually lost jobs in 5 of the last 9 months before this conflict even started. The stagflation of the 1970s is the closest historical template, and the data is pushing toward it with every passing week. In 1973, the Arab oil embargo removed roughly 5 million barrels per day from global supply. The 1979 Iranian Revolution took out about 3.9 million. The Strait of Hormuz closure is removing at least 10 million barrels per day, more than double the largest supply shock ever recorded. In 1973, the stock market ultimately fell 48% from peak to trough. Inflation hit 12%. Unemployment doubled. Recovery took nearly a decade. The U.S. economy is different today, a net energy producer with strategic reserves and a more diversified energy mix. But those structural advantages are buffers, not shields, against a disruption twice as large as anything the system has previously absorbed. And the financial system entering this crisis is already loaded down. $306 billion in unrealized losses on bank securities portfolios. 60 banks on the FDIC's problem list. The national debt above $39 trillion, growing at $7.23 billion per day. $9 trillion in treasuries being refinanced this year at rates 4 to 6 times higher than their original issuance. Interest payments on federal debt already exceeding $1 trillion annually, more than the full defense budget, before adding a single dollar of conflict-related spending. The conflict is now entering its second month with no diplomatic resolution in sight. Every week it continues, the economic damage compounds and the diplomatic window narrows. The military options now under consideration would escalate both the strategic stakes and the market uncertainty. Markets price political cost in real time, and right now that cost is rising. Morgan Stanley's formula, every $10 per barrel increase sustained over 12 months cuts U.S. GDP growth by about 0.2% and adds roughly 0.3% to consumer price inflation. Oil is up approximately $30 from pre-conflict levels. That translates to roughly 0.6% less economic growth and approximately 1% more inflation already mechanically embedded in the system. Not projected. Already transmitting through diesel prices, food transport costs, manufacturing inputs, and the pump price you see every time you fill up. Here is your timeline. The pause on escalation against Iran's energy infrastructure expires April 6 at 8 p.m. Eastern. The troop deployment decision comes next week. Between now and then, every military signal and diplomatic development will move markets in directions most investors are not positioned for. Monday's market open will reflect a weekend that includes a 48-hour ultimatum, 10,000 troops, $112 oil, and a recession model sitting at 49%. That is not a setup for a quiet week. Let me be direct about what you do with this information. Number 1, get serious about the April 6th timeline. That strike pause expiration is a binary event. Either there is a deal or the situation escalates to a new level. Position before that date, not after. Number 2, protect your liquidity right now. If you do not have 6 to 12 months of expenses in cash, that is your first move. Not bonds, not equities. Cash in an FDIC-insured high-yield savings account. The best accounts are still paying 4 to 5% APY. Veromoney is at up to 5%. Axos Bank at up to 4.21%. Newtek Bank at up to 4.2%. The national savings rate average is still just 0.39%, which means most Americans are funding their own purchasing power erosion while the banks keep the difference. On $50,000, the gap between 0.39% and 4.2% is nearly $2,000 per year in earnings you are leaving behind. And if you hold more than $250,000 at any single institution, spread it now. FDIC coverage is $250,000 per depositor per bank. Everything above that is uninsured. Number 3, audit your sector exposure. If your retirement account is concentrated in technology stocks, you are sitting in the epicenter of this correction. Meta fell 8% in a single session this week. Nvidia dropped 4.2%. Technology stocks are priced for growth in low-rate, low-inflation environments, the exact opposite of what we are entering. Shifting toward energy companies, defense contractors, and industrial names that benefit from the current environment is not speculation. It is recognizing that different economic regimes reward different sectors, and we have entered a new economic regime. Morningstar and Morgan Stanley have both published explicitly recommending defense and security sector exposure as a multi-year structural theme. Number 4, look at where gold is right now. Down 17% from its January peak above $5,400. In every prior crisis cycle, the initial gold sell-off caused by the same forced selling mechanics hitting every asset eventually reversed as the inflationary wave transmitted fully through the economy. The 1973 oil crisis is the exact template. Gold fell first, then surged. A 5% to 15% allocation in physical or ETF-based precious metals at these levels is not a trade. It is insurance against the exact scenario already unfolding. Number 5, talk to a tax advisor about Roth conversions before this window closes. If your traditional IRA was worth $500,000 in January and is now worth $450,000 because markets have fallen, converting a portion now means paying tax on the lower amount. When the recovery comes, every dollar of that growth lives inside a tax-free account permanently. The investors who did Roth conversions at the bottom of 2008 captured the entire recovery tax-free. The ones who panicked and sold locked in losses and missed both the market recovery and the tax optimization window. Do not make that trade. Here is the broader historical context you need. Strategists at Carson Group studied 40 major geopolitical crises across 85 years of S&P 500 history. The consistent pattern, a sharp drawdown of 5% to 15% in the weeks surrounding the event, followed by full recovery over 6 to 12 months as the shock is absorbed and the economy adapts. That recovery happened across every single case they examined. It will happen here too. But the word that matters most in that sentence is absorbed. Absorption takes time. During that time, investors who had cash, diversification, and a structure built for volatility added to positions at lower prices. Investors who were concentrated, illiquid, and reactive locked in permanent losses. David Lott, Chief Investment Officer at Crux Financial, said it explicitly this week. The stock market has made new 2026 lows, which suggests the market may not have yet found its bottom and is still in the process of sorting out and pricing in the duration of the Middle East conflict and the oil price outlook. A professional money manager telling you in plain language, the selling is not finished, and the repricing is still in progress. Here are 3 questions you need to sit with right now. If you are 5 years from retirement and your portfolio is down 10% with more potential downside ahead, do you have the runway to wait for the recovery? If you are already retired and drawing income from your investments, can you sustain withdrawals through a sustained downturn without being forced to sell at the bottom? If your household is running on a budget where $4 gas and higher grocery prices for the next several months is genuinely difficult to absorb, what is your plan? These are not rhetorical questions. They have real answers. And those answers determine whether this period of volatility becomes a crisis or an opportunity. There is a word for what most investors do in moments like this. Panic. And a different word for what the ones who come out the other side do. Preparation. Panic is calling your broker on Monday morning because the weekend news flow scared you into selling. Preparation is having already built the liquidity buffer, already diversified the sector exposure, already structured the tax situation so that Monday's open is not a crisis you are reacting to but a market environment you already planned for. One of those paths locks in losses you never recover. The other positions you for the rebound that every historical case confirms is coming. The investors who came through 2008 with their financial position intact, who actually emerged stronger during the recovery, were not smarter or luckier. They had built margin into their financial lives. Liquidity margin. Portfolio margin. Time margin. The investors who panicked, who sold into the bottom, who let the headlines override the plan, locked in losses that took 4 to 6 years to fully recover. They did not just lose money. They lost time. And time is the asset that cannot be replaced. Build the emergency fund. Review your sector concentration. Look at the gold pullback with clear eyes. Explore the Roth conversion window with your tax advisor. And follow what happens between now and April 6th with the same attention you give to anything that shapes the financial landscape you will be living in for the rest of this decade, because this is that moment. Subscribe and turn on notifications. Every major development in this crisis gets covered on this channel in real time, translated from geopolitical and economic signals into the financial consequences that actually affect your money and your household. Share this video with anyone who has a retirement account, a mortgage, or a grocery budget, because by Monday morning, the market will already be responding to everything we just covered. The only variable is whether you respond first.